All right, chapter 22 is another fairly short chapter. We're going to talk about responsibility accounting. We're not going to talk about transfer pricing, so it makes it even shorter. All right, so if you've ever worked for a company, you know that companies are subdivided. It's much easier to control a company overall if you break it down into subdivisions. And so these subdivisions can be and there's several reasons why, but one of the main reasons is to be able to give responsibility for certain areas of the company to certain managers, and then be able to monitor these managers' performance within those subdivisions. If you can do that, then and improve performance in those subdivisions, then you certainly would create efficiencies in the overall organization. And so one of the things that managers need in order to either, if they're the overseeing manager of certain responsibility centers, then they need information to determine how these responsibility centers are performing. Certainly if you're the manager responsible for a particular responsibility center, then you certainly need information concerning the responsibility center performance so that you can, throughout the year, make adjustments accordingly should you need to. And so you need an accounting system that tracks the performance of these particular responsibility centers. And so this information that comes out of the accounting system for responsibility centers is used to plan and allocate resources. Certainly you want to allocate resources to those responsibility centers that are performing at an optimum rate or an optimum capacity. Control operations. If you're not doing what you're supposed to be doing, not performing at what management thinks is an optimum level, or at least a minimum acceptable level, then things need to change. And so this information helps them control these operations. And of course, the accounting system provides information by which to either reward or possibly not reward the performance of these center managers. So let's think of some responsibility centers. And responsibility centers can be found at several levels. Certainly, if you're a retail store, The store itself is a responsibility center, but normally what companies do is they further subdivide into different departments, and each department itself is a responsibility center. Now, some of these responsibility centers are responsible for both revenues and costs. Some responsibility centers are only responsible for costs. Some are responsible for investment, revenues, and costs. So we'll be talking about that here shortly. So a responsibility center that's responsible only for costs is called a cost center. It's a business section that has control over the incurrence of costs, but no control over revenues or investment funds. Good example of a cost center within a company is the accounting department and other departments that simply provide support services to those departments that either produce product or sell product or sell product. HR department would be another example of a cost center. They only incur costs. They don't have any responsibility over generating revenue or investing funds. Now compare that with a profit center. And so an accounting report for a cost center would just include the costs incurred by that responsibility center. Profit center has both control over revenues and costs. What they don't have control over is investment of funds. And so for profit centers, the kind of information that they will get kind of looks like an income statement that records revenues generated by that responsibility center, as well as the costs incurred by those responsibility centers. And then a profit center is where management makes capital investment decision. And when they talk about management here, they're really referring to managers who are overseeing this particular type of responsibility center. Not necessarily the higher ups, although major investments would be at upper level management. These are fairly mid to low level investment decisions we're talking about, not major capital decisions that affect the overall business. The other thing that I forgot to note here, for cost center, another evaluation measure besides cost control is the quantity and quality of the services that the cost center provides. So what might that be? For a maintenance department, you might look at, their job is to maintain the equipment for all these other departments, production departments, HR provides support services for all other departments, including cost centers or profit centers and investment centers. And so, they might be judged on how well they're managing employee turnover or, something like that. Profit center, the main evaluation measure is profitability. They control not only the revenues, but they control costs. So a big part of this is profitability. And then investment center, certainly they're responsible for profitability and cost, but as well their responsibility for how well they manage their investments in assets. And so a couple of gauges of valuation would be return on assets as well as residual income. And so an responsibility accounting system is an accounting system that provides information relating to the responsibilities of the particular managers who oversee these responsibility centers, and is used by those above those managers to evaluate how well those managers are at controlling items that they have control over, whether it be revenues, whether it be costs, whether it be investments. And so we'll talk about budgets in a separate chapter. But responsibility accounting usually starts with some sort of budget. Might be a yearly budget, might be a quarterly budget, might be a monthly budget, might be all of the above. But we prepare budgets for each responsibility center, and then and usually that's a participatory type of thing, which involves the people within a particular responsibility center. You don't want these budgets just coming from up high, top management, and say, here's your budget. This is what you're responsible for. Usually it's a bottom-up approach, starts with people within a particular responsibility center building the budget and then presenting it to some sort of budget committee, which usually has some higher-ups involved. Second thing is that the responsibility accounting system measures performance of each responsibility center. So essentially what it is you've got your budgeted numbers for revenues, costs, whatever, and the responsibility accounting system compares actual, and let's just deal with a revenue center. Compares actual budgeted numbers for revenue and or costs so it compares actual numbers with the budgeted numbers. And of course, in revenues, if actual revenues are greater than budgeted revenues, that's a good thing. If actual revenues are below budgeted revenues, that's not such a good thing. Same for costs. Well, kind of the inversion there. If costs are more than budgeted costs, that's a bad thing. If actual costs are less than budgeted costs, that's actually a good thing. And the other part of this, another factor, is that these reports that come out of the responsibility accounting system for each responsibility center, these reports must be timely so that the managers responsible for these particular responsibility centers can take corrective action to fix the problem before it's too late. And so another consideration for implementing this responsibility accounting system might be the use of organizational charts which delineate the lines of authority and clearly define the levels of responsibility. And so if you notice, you've got top management, of course you got board of directors, top management. Here you've got two divisions in this example. Note that all those top divisions and certainly top management and board of directors are considered investment centers because not only are they responsible for revenues and costs, they're responsible for investing at some level or another particular assets. Now note that when you get down to the line below retail division, you've got your two stores there. Those stores are profit centers because not only do they generate revenues, but they incur costs as well. And then below each store, you have different types of responsibility centers. You've got a sales department that it's a profit center because it's responsible for both revenues and costs. Repairs department, same thing. And then you've got your support departments, accounting and janitorial, which are supporting the other departments. And so those only incur costs. So those are cost centers. And notice how everything flows up. So notice that retail and mail order division are both responsibility centers. And then under retail, these two stores are both responsibility centers. Notice that each department in a particular store are responsibility centers. So there's different levels of responsibility centers, and all those responsibility centers, the costs and revenues or revenues from those flow up into the next level of responsibility center. In this example, those four departments, revenues and or costs, flow up to the store level. So what they're noting here is that the amount of detail provided in these responsibility reports is varied among different organizations. Some organizations want deep detail and some don't. Within a particular department or within a particular company, certain levels want more detail than others. As you go up the responsibility chain, top management wants summary information, whereas if you're responsible for a particular profit center, you're going to want more detailed information. So your reports that you're going to get out of this responsibility accounting system is going to be fairly detailed, whereas your boss might get a report of several responsibility centers below them that are of less detail. And so this is what's called management by exception, where the more upper level managers within an organization are only getting summary reports because they really don't need to get into the details unless they see a problem. Now, these responsibility accounting reports need to be, as I've said before, timely, because if they are timely and there's a problem, then the manager that is responsible for that particular responsibility center can try to fix the problem before it's too late. These responsibility accounting reports need to be issued regularly. This can't just be a one-year thing. At the end of the year, imagine creating a budget, never receiving a timely report that's issued regularly, and then you come up to the end of the year, you get your year-end report, and that's the only report you ever get, and there's a problem. Well, by that time it may be too late, at least for that particular past year. The other thing is that these reports need to be made understandable. They must be understandable to the manager who is over a particular responsibility center. So it may need to be customized to particular responsibility centers and to particular managers, or at least there needs to be some training as to how these responsibility accounting reports are interpreted. And again, these reports compare actual to budgeted amounts. Excuse me. So, how do we assign revenue and cost to particular responsibility centers? Well, usually that's pretty easy. For revenue, you have ways of tracking sales to a particular profit center. That could be through barcodes, cash registers, things like that, that record the information that attributes a sale to a particular profit center. So that's usually fairly easily trackable. As far as allocating costs to a particular responsibility center, a little more complicated. And they talk about two guidelines that should be followed in allocating costs to the various profit or cost centers throughout the company. And so in allocating costs, you have to allocate based on cost behavior patterns, which is basically just figuring out whether or not a cost is fixed or variable. And then you also allocate costs based upon whether the costs are directly traceable to the centers involved. If a cost is not directly traceable to a particular center, then that means that the manager over that particular responsibility center shouldn't be held accountable for that cost. If it's not directly traceable to a particular responsibility center, that means that it covers more than one center, maybe several centers. So that's the first problem. The second problem is that you can't hold a manager responsible for costs that aren't directly traceable to their center, because they really don't have much control, if any control, over that cost. And so here they have an example, New Tech Electronics. And so this is starting at page 960 in the 17th edition. And so they have two divisions, retail and mail order. We kind of looked at this before. So again, this starts really at the bottom and you work your way up. And so note, you have a store, which is part of the retail division, and certainly the retail division is a profit center. And then, of course, each store is a responsibility center, a profit center. And then within each store, you have various profit centers, here sales and repairs. And so here you can take, for the whole division, you can take and summarize total sales of that division. Well, here, the total sales of the retail division come from 2 stores. And so, you're just summing across right to left. And here they're making a contribution, kind of a modified contribution margin income statement, because it's got some additional things in here. But here you've got the contribution margin overall and from each store. You've got below contribution fixed costs that are traceable to each store. And so if it's traceable to a particular store, they should be responsible for that fixed cost. And so what you have is something called a responsibility margin. And responsibility margin is contribution margin less fixed costs that are traceable to a particular store in this example. And so you've got your store responsibility margin, and then it's totaled under retail division. And then you have common fixed costs. And this is only the responsibility margin after deducting common fixed costs from store responsibility margin is only shown at the very top level, in this case, retail division, to come up with the responsibility margin for the division. So notice how the fixed cost responsible or traceable to a particular store, in this case 60,000, is further divided into the fixed cost traceable to certain departments. In this case, the $32,000 fixed cost traceable to that particular store is further divided into $18,000 for the sales and $14,000 for the repair department. Now you may ask, you've got 60 and that's only 32. Well, the other part of that, the other 28, is the common fixed costs among those two profit centers of 28,000. So notice this is a bottom-up approach. And then what they're pointing out here under traceable fixed cost, how do you determine if it's traceable? Well, a way to look at this is that a cost is traceable to a particular responsibility center. A fixed cost is traceable to a particular responsibility center. Is the way you determine that is if the cost itself would go away if that particular responsibility center no longer existed. And so here their example is if what would happen if we don't have a repair department. Well, if we don't have the repair department, we're not responsible for paying the repair department manager. Common fixed costs arise because of the overall operation of the company and are not due to the existence of a particular center. Here, no repair department. If you didn't have it, you'd still have somebody running the company. Here, the company president. Another probably better example would be the overall structure, and within that structure you have a repair department. You're still going to have the structure and the cost of the structure that the various departments are in, and so no repair department within that structure means you still have the cost of the structure. And so again, for profit centers, you have what are called contribution margin responsibility reports. With this included couple of extra lines. Fixed cost traceable to divisions is subtracted from the contribution margin, and then to come up with the division, well, each business center's responsibility margin as well as the overall division, in this case, responsibility margin. And then you have common fixed costs that's deducted from the division responsibility margin to come up with operating income and so on. And so the responsibility margin is the best gauge of the long-run profitability of a business center, of a profit center. And so they ask the question, when is a responsibility center unprofitable? Well, it's when the responsibility margin is negative. So as they point out here, contribution margin is used for short-term decisions, but the responsibility margin is used for more long-term decisions. And so the question they ask here in this scenario is whether or not repairs should be discontinued because the responsibility margin is negative. Well, I would say that in this scenario, one report, responsibility margin report would probably, and it's a fairly insignificant amount overall. So, over time, if this continues, if the responsibility margin for this department continues to be negative, I would say that they certainly should consider getting rid of the repairs department. Either that, or what they could do is figure out maybe if there's some more fixed costs that can be shared with the sales department, maybe make the sales department manager also the manager over repairs department, thereby cutting out some of the fixed costs traceable to departments. That would be a common fixed costs. And so again, managers should only be held responsible for things that they have control over, whether it be revenue or whether it be costs. Common fixed costs can't be traced to, in this case, either department, and so neither manager for those departments should be responsible for those costs, and therefore those costs are not shown in those particular departments' responsibility margin. Now, what they're discussing here is whether or not common fixed costs should be allocated at all. And so here they're arguing against allocating common fixed costs, and the reasons why. Common fixed costs would not change even if a business center were eliminated. Common fixed costs are not under the direct control of the center's managers. And allocation of common fixed costs may imply changes in profitability that are unrelated to the center's performance. So, that's it for responsibility centers. Wednesday, I will do an example problem for Chapter 22.